You know, people think I'm crazy. They always have. When I bet against the housing market in 2006, they called me insane. When I warned about the index fund bubble, they laughed. And now, when I'm telling you that the Magnificent Seven stocks are sitting on the edge of the biggest cliff in modern market history, I already know what they're going to say. But here's the thing. I've been right before when everyone else was wrong, and I'm going to be right again. Let me take you back to a moment that changed everything for me. It was early 2005, and I was sitting in my office at Scion Capital, staring at mortgage bond data that didn't make any sense. Everyone around me was celebrating the greatest housing boom in American history. Real estate agents were becoming millionaires. Banks were throwing money at anyone with a pulse. And there I was, looking at default rates and payment histories. And I realized something terrifying. The whole thing was built on sand. I remember the feeling in my gut. It wasn't just about the numbers, though the numbers were damning. It was about human nature. It was about what happens when everyone believes the same story, when groupthink takes over, when people stop asking the hard questions, because asking those questions makes you the outsider, the contrarian, the crazy one. Fast forward to today, and I'm having that exact same feeling. Except this time, it's not about subprime mortgages. It's about 7 companies that have become so dominant, so universally loved, so completely embedded in every investor's portfolio that questioning them has become almost heretical. I'm talking about Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia. The Magnificent Seven, as they love to call them. Let me tell you something that should terrify you. These 7 companies now represent approximately 30% of the entire S&P 500 market capitalization. Think about that for a second. 7 companies out of 500, 30% of the total value. In the history of modern markets, we have never seen concentration like this. Never. And every single time we've come close, every single time a small group of stocks has dominated the market to this degree, it has ended in disaster. But here's what really keeps me up at night. It's not just that these stocks are overvalued, though they absolutely are. It's not just that their price to earnings ratios have detached from any reasonable fundamental analysis, though they have. It's that the entire financial system has reorganized itself around the assumption that these companies will keep growing forever. And that assumption, my friends, is about to be tested in ways that most investors can't even imagine. Let me walk you through exactly how we got here, because understanding the path is crucial to understanding where we're going. After the financial crisis of 2008, central banks around the world did something unprecedented. They dropped interest rates to 0 and then kept them there for over a decade. They pumped trillions of dollars into the financial system through quantitative easing. And what happened? That money didn't flow evenly through the economy. It pooled in the places that seemed safest, that seemed most certain, that seemed like they could never fail. Technology stocks became the new safe haven. And not just any technology stocks. The biggest ones, the most established ones, the ones with the strongest moats and the most predictable cash flows. Institutional investors, pension funds, sovereign wealth funds, they all made the same bet. They bought the Magnificent Seven and they kept buying. And as they kept buying, the prices kept rising. And as the prices kept rising, more investors piled in because nobody wants to miss out on returns. This created a self-reinforcing loop. The kind of loop I saw in housing in 2006. The kind of loop that always ends the same way. But there's something even more insidious happening here. The rise of passive investing has turbocharged this concentration. Think about what happens when someone puts money into an S&P 500 index fund. They're not making individual stock picks. They're buying the entire index in proportion to market capitalization. And because the Magnificent Seven have such enormous market caps, every dollar that flows into index funds disproportionately flows into these 7 stocks. It's automatic, it's mechanical. And it's creating a bubble that's hidden in plain sight because it's dressed up as prudent, diversified investing. I've done the math, and the numbers are staggering. In the last 5 years alone, over $2 trillion has flowed into passive index funds. And a massive chunk of that money, probably $600 billion to $700 billion, has been automatically funneled into the Magnificent Seven. These aren't investors making conscious decisions about valuation or growth prospects. These are automatic purchase orders driven by algorithms and fund flows, completely divorced from fundamental analysis. Now let's talk about valuations, because this is where things get really interesting. Take NVIDIA, for example. As of my last analysis, NVIDIA was trading at a price-to-earnings ratio somewhere in the 70s. Now, the bulls will tell you that's justified because of artificial intelligence, because of their dominance in GPU manufacturing, because of the growth story. And look, I'm not saying NVIDIA isn't a good company. I'm not saying they don't have real advantages. What I'm saying is that at 70 times earnings, the market is pricing in decades of perfect execution, zero competition, and unlimited growth. Let me put this in perspective. During the dot-com bubble, Cisco Systems was the darling of the market. Everyone loved Cisco. They were the backbone of the internet. They had dominant market share. They were growing like crazy. At the peak in March of 2000, Cisco was trading at over 200 times earnings. People said it was worth it. People said the internet was going to change everything and Cisco would own the infrastructure. They were right about the internet changing everything. But Cisco stock still crashed 86% over the next 2 years. It took 17 years for Cisco to get back to its 2000 high. 17 years. And here's the kicker. Cisco's business actually continued to grow during most of that time. Revenue kept increasing. They remained the dominant player in networking equipment. But the stock crashed anyway because the valuation was insane. The market had priced in perfection, and when reality fell even slightly short of perfection, the multiple collapsed. Now look at today's Magnificent Seven. We've got companies trading at 50, 60, 70 times earnings. We've got Tesla with a market cap larger than all other major auto manufacturers combined, despite making a fraction of the cars. We've got Meta trading like it's a guaranteed winner in the metaverse when nobody even knows if the metaverse is going to be a thing. We've got Amazon commanding premium valuations on retail operations that have razor-thin margins. But Victor, you might be thinking, these companies have real earnings. They're not like the dot-com companies that had no profits. And you're right, that's what makes this bubble so dangerous, because it's not obviously a bubble. It's got just enough fundamental support to keep people convinced that this time is different. Those are the 4 most dangerous words in investing, by the way. This time is different. It never is. Let me tell you about the revenue problem. For these 7 companies to justify their current valuations, they need to maintain extraordinary growth rates for the next decade. I'm talking about double-digit revenue growth year after year for 10 years. And here's the problem. These companies are already enormous. Apple is a $3 trillion company. Microsoft is a $3 trillion company. When you're that big, the law of large numbers starts to work against you. Think about it mathematically. For Apple to grow revenue by 10%, they need to add revenue equivalent to creating another $300 billion company every single year. That's not impossible, but it's incredibly difficult. And the bigger they get, the harder it becomes. Eventually, you run out of customers. Eventually, you saturate the market. Eventually, growth slows down. It's not a question of if, it's a question of when. And the market hasn't priced in when. The market has priced in never. The market has priced in eternal growth. That's delusional. But it gets worse. Let's talk about competition and disruption, because that's the other side of this equation. One of the core assumptions baked into these valuations is that the Magnificent Seven have insurmountable competitive advantages, that their moats are so wide that no competitor can threaten them. And in the short term, that might be true. But in the long term, in technology especially, dominance is always temporary. Always. Think about the dominant tech companies from 20 years ago. Where's Yahoo now? Where's BlackBerry? Where's Nokia? Where's MySpace? Where's AOL? These weren't just successful companies. They were dominant. They had massive market shares. They seemed invincible. And then they weren't. Technology moves fast, consumer preferences change, new platforms emerge, and the giants fall. Now, I'm not saying Apple is going to become the next BlackBerry, But I am saying that assuming Apple, Google, Amazon, Microsoft, Meta, Tesla, and Nvidia will all maintain their current dominance for the next 10 to 20 years is incredibly naive. Statistically, at least one or two of these companies will face serious competitive threats that materially impact their business models. And here's what the market hasn't priced in. These 7 stocks move together now. They're correlated. When one goes down, they all go down. When one goes up, they all go up, because they're all in the same funds, held by the same institutions, bought and sold by the same algorithms. So when one of them stumbles, really stumbles, it's going to trigger selling across the entire group. And because these 7 stocks are 30% of the S&P, that's going to trigger selling across the entire market. Let me paint you a scenario. It's not a prediction, it's a possibility. But it's a possibility that keeps me up at night. Imagine Nvidia misses earnings, not by a lot, just by a few percent. But it's enough to make investors nervous about the AI growth story. The stock drops 10% in a day. That triggers automatic selling by risk parity funds and volatility targeting funds. As Nvidia drops, it pulls down the tech sector. The other Magnificent 7 stocks start to fall because they're all correlated. Passive index funds have redemptions because retail investors get nervous. But passive funds can't just sell Nvidia. They have to sell everything in proportion to the index. So now the selling spreads beyond tech. The S&P starts to drop. As the S&P drops, more funds hit their volatility targets and have to reduce exposure. More systematic selling kicks in. And suddenly, you've got a cascade. This is exactly how the crash of 1987 happened. It wasn't triggered by some massive fundamental problem. It was triggered by portfolio insurance strategies and program trading that created automatic selling loops. And we've got the exact same dynamics in place today, except they're even more powerful because passive investing is so much bigger. But let me go deeper into why I think the Magnificent 7 are uniquely vulnerable right now. It's about the macro environment. For the last 15 years, these companies have operated in a world of zero interest rates, unlimited liquidity, and no real competition for investor capital. That world is over. Interest rates have risen dramatically. The Federal Reserve has gone from 0% to over 5%. And while rates might come down from here, we're not going back to zero. That changes everything. When rates are at zero, investors have no choice but to take risk. There's no yield in bonds. There's no return in savings accounts. So they pile into stocks, especially growth stocks, especially tech stocks. But when rates are at 4 or 5%, suddenly there are alternatives. Suddenly, a 10-year treasury paying 4.5% looks pretty attractive compared to a stock trading at 70 times earnings. This is basic finance. When the risk-free rate goes up, the present value of future cash flows goes down. And growth stocks are all about future cash flows. These companies are valued on what they're going to earn 10, 15, 20 years from now. When you discount those future earnings at 5% instead of 0%, the valuations collapse. It's just math. And then there's the liquidity issue. The Federal Reserve isn't just raising rates. They're shrinking their balance sheet. They're pulling liquidity out of the system. For 15 years, central banks were adding liquidity, buying bonds, propping up asset prices. Now they're doing the opposite. And when liquidity drains out of the system, it comes out of the most overvalued assets first. It comes out of the things that were most inflated by easy money, like the Magnificent 7. But here's what really worries me. It's the confidence factor. Right now, investors are completely confident in these stocks. They're not even questioning them. I see pension funds. I see insurance companies. I see sovereign wealth funds, all holding enormous positions in the Magnificent 7 with no hedges, no protection, no plan B. They've convinced themselves that these are safe, stable, blue chip stocks that will just keep going up forever. That confidence is fragile. It's based on recent performance, not on fundamental analysis. And when it breaks, when people start to question whether Apple really deserves a $3 trillion valuation, when they start to wonder if AI is going to deliver the returns that NVIDIA's stock price implies, when they start to worry that maybe, just maybe, these stocks have gotten ahead of themselves, the selling is going to be vicious. I saw this in 2007 and 2008 with housing. People were absolutely convinced that home prices could never go down. They had decades of data showing home prices going up. They had sophisticated models from smart people at big banks telling them housing was safe. They had rating agencies giving AAA ratings to mortgage bonds. And they were all wrong because they were all looking at the same data, using the same models, making the same assumptions. Right now, everyone is looking at the same data on the Magnificent Seven. Everyone is using the same growth assumptions. Everyone is extrapolating the same trends. And everyone is wrong. Because markets don't move in straight lines, growth doesn't continue forever, and valuations always, always mean revert. Let me tell you about valuation mean reversion, because this is one of the most powerful forces in markets and one of the most consistently ignored. Over long periods of time, stock valuations tend to revert to their historical averages. When stocks get overvalued, they eventually come back down. When they get undervalued, they eventually go back up. It's not magic. It's just how markets work. The historical average price to earnings ratio for the S&P 500 is around 16 times earnings. Right now, we're at around 25 times earnings. And most of that premium is because of the Magnificent Seven. If you take those 7 stocks out, the rest of the S&P is trading much closer to historical averages. So we've got massive concentration in overvalued stocks pulling up the entire index. When mean reversion happens, and it will happen, those 7 stocks are going to fall harder than anything else because they're the most overvalued, because they're the most crowded, because they're the most loved, and because when everyone is on one side of the boat tips. I want to talk about something that most investors don't think about, the regulatory risk. These companies have gotten so big, so dominant, that they've attracted serious regulatory attention. The Department of Justice is investigating Google. The FTC is looking at Amazon. There are antitrust cases brewing against Meta. European regulators are going after Apple. And this is just the beginning. Governments around the world are starting to realize that these companies have too much power. They control too much data. They have too much influence over information, commerce, and communication. And governments don't like that. History shows us that when companies get too dominant, regulators step in. They break them up. They impose restrictions. They limit their ability to grow. Now, I'm not predicting that the Magnificent Seven are going to be broken up tomorrow. But I am saying that the regulatory environment is getting more hostile, not less. And that's going to impact growth. That's going to impact margins. That's going to impact valuations. And the market hasn't priced that in at all. There's also the China factor. Several of the Magnificent Seven have significant exposure to China. Apple manufactures there, Tesla sells there, NVIDIA's chips go there, and US-China relations are getting worse, not better. We're in a new Cold War. There are technology restrictions. There are tariffs. There are supply chain pressures. And if tensions escalate further, if there's a real crisis over Taiwan, these companies are going to be caught in the crossfire. The market is pricing in business as usual. Free trade, open markets, stable supply chains. That's a very optimistic assumption. And optimistic assumptions are dangerous when they're baked into trillion-dollar valuations. Let me circle back to something I mentioned earlier, the passive investing trap. Because this is really the mechanism that's going to turn a correction into a crash. When the Magnificent Seven start to fall, passive funds are going to be forced to sell. Not because fund managers make a decision to sell, but because investors redeem their shares and the funds have to raise cash. And here's the problem. Passive funds have to sell proportionally. They can't just sell their worst performers or their most overvalued stocks. They have to sell everything according to the index weights, which means they have to keep selling the Magnificent Seven even as those stocks are falling. This creates a death spiral. Falling prices trigger redemptions, which trigger more selling, which triggers more falling. prices. Active managers might step in and buy at some point. Value investors might see opportunities. But the passive selling is mechanical and relentless. It doesn't care about valuation. It doesn't care about fundamentals. It just sells. And given how much money is in passive funds now, that selling pressure is going to be enormous. I've watched markets for over 30 years. I've seen bubbles inflate and pop. I've seen manias and panics. And I'm telling you, what we're seeing right now in the Magnificent Seven has all the hallmarks of a major market top. Extreme concentration, elevated valuations, universal bullish sentiment, passive flows driving prices, regulatory risks being ignored, macro headwinds being dismissed, competitive threats being downplayed, every single warning sign is flashing red, and yet most investors are still buying. They're still convinced this is different. They're still sure that these companies are special enough, innovative enough, dominant enough to justify any price. They're wrong. Now, I know what some of you are thinking. Burry's been early before. He was early on the housing crisis. He held his positions for years while everyone mocked him. And you're right, I might be early on this too. These stocks might keep going up for another 6 months, another year, maybe even longer. Bubbles can stay irrational longer than you can stay solvent, as the saying goes. But being early is different from being wrong. I was early on housing, but I was right. The crash happened. The people who ignored the warnings lost everything. The people who positioned for it survived and prospered. And I'm willing to be early on this because the risk-reward is so asymmetric. If I'm wrong, if the Magnificent Seven keep going up, okay, I miss out on some gains. But if I'm right, if this bubble pops the way I think it's going to pop, the downside is catastrophic. We're talking about trillions of dollars in market value evaporating. We're talking about retirement accounts being cut in half. We're talking about a broader market crash that could rival 2008. So what do? How do you protect yourself? First, understand your exposure. Most investors have way more exposure to the Magnificent Seven than they realize. If you own an S&P 500 index fund, 30% of your money is in these 7 stocks. If you own a NASDAQ index fund, it's even more. If you own a total stock market fund, you've got significant exposure. Add up all your holdings and figure out exactly how much of your portfolio is concentrated in these names. Second, consider reducing that concentration. I'm not saying sell everything. I'm not saying go to cash. But if 40 or 50% of your net worth is riding on 7 stocks staying at all-time high valuations, that's a huge risk. Maybe trim some positions, maybe take some profits, maybe rebalance into other sectors that aren't as overvalued. Third, look for protection. Put options on these stocks are expensive right now because implied volatility is high, but expensive insurance is still worth it when the house is on fire. You could buy put options on the Magnificent Seven or on the NASDAQ as a hedge. You could buy inverse ETFs. You could shift some allocation to bonds or gold or cash as a buffer. Fourth, look for opportunities outside the bubble. There are sectors and stocks that have been completely ignored while everyone chased the Magnificent Seven. Energy stocks, financial stocks, small cap value stocks, international stocks. These are trading at much more reasonable valuations. They're not as exciting, they're not as popular, but they're not priced for perfection either. And fifth, be patient. When this bubble pops, when the selling starts, there's going to be incredible opportunity, but you need to have dry powder. You need to have cash or cash equivalents ready to deploy. You need to be in a position to buy when everyone else is panicking. That's how generational wealth is built. Not by chasing bubbles, but by having the courage and the capital to step in when assets are truly cheap. I've been doing this a long time. I've made a lot of money by betting against the crowd. And I've learned that the best opportunities come when you're willing to stand alone, to question the consensus, to trust your analysis even when everyone thinks you're crazy. The housing short was like that. This is like that. The Magnificent Seven are going to crash. I don't know exactly when. I don't know what the catalyst will be. Maybe it's a recession. Maybe it's an earnings miss. Maybe it's a regulatory action. Maybe it's just exhaustion, just running out of buyers willing to pay higher prices. But it's going to happen. Because it always happens. Because trees don't grow to the sky. Because valuations matter. Because mean reversion is real. And when it happens, the people who ignored the warnings are going to lose a fortune. The institutional investors who loaded up on these names because they were trending, the retail investors who piled into index funds because that's what everyone said was safe, the pension funds that bet the retirement security of millions of people on the idea that these 7 stocks would keep going up forever, they're all going to get crushed. But the people who prepared, who understood the risks, who positioned themselves appropriately, they're going to be okay. More than okay. They're going to have opportunities that come once in a generation. That's what happened after the dot-com crash. That's what happened after the housing crisis. And that's what's going to happen after the Magnificent Seven crash. I'm not trying to scare you. I'm trying to wake you up. The signs are all there. The concentration is unprecedented. The valuations are extreme. The risks are being ignored. The selling mechanisms are in place. Everything is aligned for a major crash. All that's missing is the trigger. And triggers always come. Sometimes they're obvious in retrospect. Sometimes they come out of nowhere, but they always come. So take this seriously. Look at your portfolio. Understand your risks. Make adjustments while you still can. Because once this starts, once the selling begins, it's going to be too late. The exits are going to be crowded. The liquidity is going to dry up. And the destruction is going to be swift and brutal. I've been called a lot of things in my career. Contrarian, pessimist, doom and gloom merchant. And yeah, sometimes I am those things. But I'm also a realist. I look at data. I analyze trends. I understand market structure. And I'm willing to make the unpopular call when the evidence supports it. The evidence right now supports a massive crash in the Magnificent Seven. The concentration is too high. The valuations are too rich. The sentiment is too bullish. The structure is too fragile. All the pieces are in place. And history tells us how this ends. It ends badly. It always ends badly when you have this combination of factors. So that's my warning. The Magnificent Seven stocks are going to crash. It might not happen tomorrow. It might not happen next month, but it's coming. And when it does, it's going to reshape the entire market landscape. Fortunes will be lost. Narratives will change. And the investors who positioned for it, who saw it coming, who had the courage to act, they're going to be the ones who survive and thrive on the other side. That's what I did with housing. That's what I'm doing now. And that's what you should be thinking about if you care about protecting and growing your wealth in the years ahead. The crash is coming. Are you ready? Let me share something with you that most people don't understand about crashes. They don't happen because of stupidity. They happen because of intelligence. Smart people, really smart people, build these elaborate models and theories to justify why this time things are different. They create narratives that sound convincing. They point to genuine innovations and real changes in the economy. And they're not wrong about the innovations being real. They're just wrong about the valuations. In the late 90s, the internet really was revolutionary. It really did change everything. The bulls weren't wrong about that. But they were spectacularly wrong about what internet companies were worth in 1999. Pets.com really was going to change how people bought pet supplies. But it wasn't worth hundreds of millions of dollars before it had figured out how to make money. Today, artificial intelligence really is revolutionary. It really is going to change everything. The cloud really has transformed how businesses operate. Electric vehicles really are the future of transportation. Social media really has changed human communication. The bulls aren't wrong about any of that, but they're spectacularly wrong about what these companies are worth right now. And here's the insidious part. Because there's a kernel of truth in the bull case, because these companies really are innovative and dominant, it becomes almost impossible for most investors to see the bubble. They can't separate the business quality from the stock valuation. They think that because Apple makes great products, Apple stock must be a great investment at any price. That's not how it works. General Electric was one of the greatest companies in American history. Dominant, innovative, well-managed. At its peak in 2000, GE had a market cap of over $500 billion. It was the most valuable company in the world. And then it wasn't. The stock crashed 70% and never recovered. Today, GE is worth a fraction of what it was worth 25 years ago. Not because GE became a terrible company, but because the valuation in 2000 was insane. IBM was the bluest of blue chip stocks for decades, the safest investment you could make. Nobody ever got fired for buying IBM, they used to say. And then the world changed. IBM didn't adapt fast enough, and decades of shareholder value evaporated. The stock has gone nowhere for 15 years. Cisco, which I mentioned earlier, is still a good company, still profitable, still dominant in its space. But if you bought Cisco stock in March of 2000 and held it, you've made zero money. Actually, accounting for inflation, you've lost money because you paid too much, because the valuation was detached from reality. The same thing is going to happen to some, maybe all, of the Magnificent Seven. Not necessarily because they'll become bad companies, but because investors are paying prices that assume perfection. And perfection never happens. Let me tell you about a concept that's become very important to my thinking. It's called reflexivity, and it was developed by George Soros. The basic idea is that market prices don't just reflect reality, they shape reality. In other words, when stock prices go up, it changes the behavior of companies and investors in ways that can drive prices even higher, until suddenly it doesn't work anymore and the whole thing reverses. Here's how reflexivity is playing out with the Magnificent Seven. As their stock prices have soared, these companies have been able to use their inflated stock as currency. They make acquisitions using stock. They compensate employees with stock options. They buy back their own shares. All of this activity reinforces the narrative that these stocks are special, that they're worth the premium prices. Meanwhile, the high stock prices attract more investors. The companies get written about more, they get more analyst coverage, they get included in more indexes, more passive money flows in, the stocks go higher, which attracts more attention, which brings in more money. It's a self-reinforcing cycle. Reflexivity at work. But here's the thing about reflexivity. It works in both directions. On the way down, all those positive feedback loops become negative feedback loops. Stock options become worthless, hurting employee morale and retention. Acquisitions using stock become impossible. Buyback programs get suspended. Analyst coverage turns negative. Investors flee. Passive funds experience redemptions and have to sell. The stocks fall further, which triggers more selling, which pushes prices lower still. We saw this with the FANG stocks in late 2018. Remember that? Facebook, Amazon, Apple, Netflix, Google, the darlings of the market. They all crashed together, falling 30 to 40% in a matter of weeks. And that was just a correction. That wasn't even a real bear market. Imagine what happens in an actual bear market when sentiment really turns. What worries me is that today's concentration is even more extreme than it was in 2018. The passive flows are bigger. The valuations are higher. The complacency is deeper, which means the eventual unwinding is going to be more severe. I want to talk about something that nobody is discussing, the derivative exposure. Options markets on these stocks are enormous. There are billions of dollars in call options, put options, and complex derivative structures built on top of the Magnificent Seven. And many of these derivatives are sold by market makers who hedge their exposure by buying or selling the underlying stocks. This creates what's called gamma exposure. When stocks are rising and dealers are short calls, they have to buy stock to hedge. This buying pushes prices higher, which creates more call buying, which requires more hedging, which pushes prices higher still. It's another feedback loop, another form of reflexivity. But when the market turns and dealers start hedging the other way, when they're selling stock to hedge their put exposure, it amplifies the move down. We saw this in the flash crash of 2010. We saw it in the volatility explosion of February 2018. We saw it in the March 2020 COVID crash. Dealer hedging amplifies both the rallies and the crashes. And given the size of the options market on the Magnificent Seven, that amplification is going to be massive when this turns. There's also the leverage factor. A lot of the buying in these stocks has been done on margin. investors borrowing money to buy more stock. As long as stocks are going up, this works great. You make leveraged returns. But when stocks start falling, margin calls kick in. Brokers force investors to sell to meet their margin requirements. This forced selling pushes prices lower, triggering more margin calls, triggering more forced selling. Another negative feedback loop. And it's not just retail investors using leverage. Hedge funds are levered. Private equity firms are levered. Even some institutional investors use leverage through derivatives and structured products. All of that leverage is going to unwind when this market turns. And leveraged. Selling is the most brutal kind of selling because it's not discretionary. It's forced. It has to happen regardless of price. I spent months analyzing the options flow and the margin debt data. What I'm seeing terrifies me. We've got near record levels of margin debt. We've got massive call option positioning. We've got volatility at historic lows, meaning investors are paying almost nothing for downside protection because they don't think they need it. These are all classic late-stage bubble indicators. You know what else I'm seeing? Insider selling. The executives and board members at these companies, the people who know these businesses better than anyone, they're selling stock, not a little bit, a lot. Billions of dollars worth over the last year. Now, insider selling doesn't always mean a crash is coming. People sell stock for lots of reasons. But when you see concentrated insider selling at valuation peaks, it's worth paying attention to. Mark Zuckerberg has sold billions in Meta stock. Jeff Bezos has sold billions in Amazon stock. Executives at Nvidia, at Apple, at Microsoft, they're all selling. They're diversifying, they'll tell you. They're taking profits. They're funding philanthropic ventures. Maybe, or maybe they know that the valuations have gotten silly and they're smart enough to sell to the public while prices are high. I'm also watching the smart money, the sophisticated institutional investors who have long track records of good decision making. Some of them are quietly reducing their exposure to these names, not loudly, not dramatically, but steadily, trimming positions, taking profits, rebalancing away from tech. They're reading the same data I'm reading. They're seeing the same warning signs. And they're positioning for a different environment. Warren Buffett, who I respect immensely, even though we have different styles, has been selling stocks and building up cash. Berkshire Hathaway is sitting on over $150 billion in cash and short-term treasuries. Why? Because Buffett can't find good values. Because he thinks the market is overpriced. Because he's waiting for opportunities that come when markets crash. If Warren Buffett, who is the most optimistic long-term investor in American business that I know, if he thinks valuations are too high and is sitting on cash, that should tell you something. He's not a market timer. He's not trying to predict crashes, but he knows value when he sees it and he knows when he doesn't see it. And right now, he doesn't see it. Let me talk about the psychological aspect of this because it's crucial. Market tops are driven by greed and confidence. Everyone is making money. Everyone feels smart. Everyone thinks they've figured it out. Risk seems low because volatility is low. The future seems bright. Problems seem manageable. It's a wonderful feeling until it isn't. I remember that feeling in 2006. People were buying houses they couldn't afford and flipping them for profits. Everyone knew someone who had made money in real estate. It seemed like a sure thing. The psychology was bulletproof. And then it wasn't. The first cracks appeared, prices stopped rising. Then they started falling. Slowly at first, then faster. Confidence evaporated. Greed turned to fear, and the crash became a stampede. We're in a similar psychological state now with the Magnificent Seven. Everyone owns them. Everyone has made money on them. Everyone thinks they're safe. The possibility of a major decline seems remote. People have been conditioned by 15 years of central bank support to believe that crashes don't happen anymore, that the Fed will always step in and save the market. That's a dangerous belief. The Fed can't save overvalued stocks. They tried in 2000. They cut rates aggressively after the dot-com crash. The market still fell 70%. They tried in 2007. They cut rates as the housing crisis unfolded. The market still crashed. The Fed can provide liquidity. They can prevent a complete financial system collapse, but they can't prevent valuations from mean reverting. They can't force people to buy stocks at prices that don't make sense. And here's something people don't realize. The Fed might not even try to save the stock market this time. Inflation is still a concern. The labor market is still tight. If the stock market crashes but the real economy stays relatively stable, the Fed might just let it happen. They might even welcome it as a way to reduce wealth effects and cool down consumer spending. A stock market crash without a recession would actually make the Fed's job easier in some ways. So don't count on the Fed put. Don't assume that central banks will ride to the rescue. That playbook might not work this time, which means this crash could be deeper and longer than people expect. Let me give you one more historical parallel that keeps me up at night. In 1972, the Nifty 50 stocks were the darlings of the market. These were 50 large-cap stocks that were considered one-decision stocks, meaning you just buy them and hold them forever. They were high-quality companies with strong brands and reliable earnings. Companies like Coca-Cola, McDonald's, Disney, Polaroid, Xerox, the best of the best. Investors loved these stocks so much that they paid incredible premiums for them. Some of the Nifty 50 were trading at 80 or 90 times earnings. The thinking was that these companies were so good, so dominant, that they were worth any price. Sound familiar? And then the market crashed. From 1973 to 1974, the market fell nearly 50%. The Nifty 50 got destroyed. Some of them fell 70 or 80%. Companies like Polaroid and Xerox never recovered. Even the good companies like Disney and McDonald's took decades to get back to their 1972 highs when you adjust for inflation. The lesson from the Nifty 50 is clear. Quality doesn't protect you from overvaluation. Being a great company doesn't make you a good investment at any price. And when everyone believes that a group of stocks can't go down, that's usually when they're about to go down hard. The Magnificent Seven are today's Nifty 50. High-quality companies, dominant positions, strong brands, reliable growth, and massively overvalued. History doesn't repeat exactly, but it rhymes. And the rhyme I'm hearing right now is very concerning. So where does this leave us? I've laid out the case. Extreme concentration, elevated valuations, passive flows creating mechanical buying, regulatory risks, macro headwinds, leverage, derivatives, insider selling, smart money reducing exposure, historical parallels, psychological complacency, all the ingredients for a major crash. The question is timing. And that's the hardest part. Bubbles can persist longer than you think. Markets can stay irrational longer than you can stay solvent. I learned that lesson with the housing short. I was right about the crash, but I was almost too early. My investors almost pulled their money before the crash happened. I had to fight to keep the positions on. But I did, and we made a fortune when the crash finally came. I might be early on this too. The Magnificent Seven might keep rallying for a while. The bubble might get even bigger before it pops. I can't tell you the exact day or month when this will turn. Nobody can. But I can tell you with high confidence that it will turn. And when it does, the damage is going to be severe. Your job is to prepare, understand your exposure, reduce your concentration, build some cash, buy some protection. Position yourself to survive the crash and capitalize on the opportunities that will emerge. That's what I'm doing. That's what the smart money is doing. And that's what you should be thinking about. The Magnificent Seven are going to crash. The only question is whether you'll be positioned to survive it or whether you'll be one of the casualties. Choose wisely.